Hi, I'm Harper Jones with Life with Leverage, and we coach people on the infinite banking concept and how you can become your own banker. Today, we're going to talk about mechanics of infinite banking and how we can actually use our life insurance contract. So, you got two parts. You have the platform or the product, which would be the life insurance contract that we design especially for you, and that's going to be with a mutual insurance company that we work with or a few that we work with. Then infinite banking is the process of utilizing that policy and the mechanics. So we're going to go through that today. So let's go to the screen and walk through it on the computer. And as you see, we got mechanics of infinite banking. On the left side, you see it's the savings, right? So we're going to have savings and we're going to have investing. Savings is where the money is going to sit and work for you in a nice liquid guaranteed form. And you could go back to one of my other videos. What does the ideal savings vehicle look like? And that'll talk about the actual policy and characteristics we're looking for. And then you're going to have investing, where you invest in real estate, businesses, loaning friends, or other investors to make money. That's where you put your money more to work. You can build more wealth, and you're able to, but you might not have as much ability to access the liquidity just like you would with savings. So you got to separate the two. So I'm saying that because on the left side you have savings and on the right side you have investing. So on this left side you're going to have the policy. Your life insurance contract is going to have cash value or equity or cash in the policy. Then it's going to have death benefit, illness protection, creditor protection, and some other benefits that once again you can see if you go to the ideal savings vehicle video. That policy will be placed with a mutual insurance company. And the reason we use a mutual insurance company is because we're not only a policy holder as a customer, we also get to partake and participate in the profits of that insurance company and dividends, which gives us more of a snowball effect in how this infinite banking concept works more in our favor. Now, that policy, you're going to have cash in there, like I said. You're able to access that cash by withdrawing, or you're going to have very favorable loan provisions to borrow against it, which is a line of credit, essentially, called a policy loan in the insurance world. That policy loan, very unique. You can get up to 95% loan to value, typically, give or take a couple percentage points, of whatever your cash value is in that policy. You simply can use a third party like a bank to collateralize it and give you a line of credit, but the preferred method is to use the insurance company you have the policy with and get a loan from them called a policy loan. So they'll loan you funds from their big, massive pool of money, right? Their balance sheet. Your dollars never leave the policy. They stay there, they compound and grow tax-free, and you're able to just pledge as collateral and use the same dollar in two places, essentially. What's cool about this policy loan is it's OPM, other people's money, so you get to leverage that. You get entire use and control. How you repay it, when you repay it, and even if you pay the interest is completely up to you. And I'll do a separate video. I'm not sure what I'm going to call it yet, but it's going to be in regards to how to pay back policy loans and get into more of those mechanics and flows and the terms of it. But you're also going to have interest only on that policy loan. So you just have full use control of how and when to repay the principal and how it is just interest only accruing for you. When you get the funds, say you get a line of credit against the policy, you're able to have the funds deposited in your bank account within a handful of business days typically. You now use those funds. Keep in mind, yours is still in the policy compounding, and you're able to borrow from the insurance company's pool of money and go put it wherever you like and get that within a handful of business days. We put those funds, let's say, in real estate. That real estate should cash flow back to us. We might refinance the property. We might sell the property. We get the funds back to our bank accounts, right? And we can say, hey, do we have another opportunity to deploy those funds? Or do we want to send it back to policy with some interest back to our bank or our warehouse, so to speak, before we redeploy it later on? So say you have an opportunity, let's just go buy a business, right? Or invest in a business, have that cash flow back. Then maybe we redeploy it to loan money out to someone. And it could be a hard money loan or a private money loan, make some money. And some people might say, hey, I got property taxes, insurance premiums, personal taxes, or personal reserves. Where am I going to sit those? A lot of people will sit those funds at a third-party bank. They're going to let that bank take that in a separate savings account or checking account, and they're going to go loan that out in profit, well, why don't we just flow that through our own bank or our own policy, recapture interest, or gain more interest on our funds that we otherwise were escrowing over here and funnel it through our policy, get a little bit more advanced in our infinite banking concept. Now, these assets over here are going to give you a rate of return, hopefully, if you bought them right, and then a rate of cash flow. So it's paying you each month or every few months or every year. Then you are going to have this system where you have your savings working for you, right? Then you have your investments working for you, and you pair them together, which is really infinite banking, because you're also the lender, right, to yourself. So essentially, you are velocitizing your money. And this little diagram here, it's hard to read, but essentially we're talking about keeping your money in motion. It's velocitizing the same dollar, reusing it to make more money, and recycling the same dollar, and just fully keeping the money in motion, right? And that's truly what infinite banking is. Now, the policy is going to have a rate of return tax-free, and then you're going to have a legacy rate of return with the death benefit. At some point you pass away, you are able to give that to beneficiaries income tax-free, to charities, pay off debts, whatever that might be for the next generation or generations. And you also, if you need to plan for estate taxes to bypass some of that or get creative, I'm no attorney or CPA, but we are able to actually move those policies out of your estate in the form of irrevocable life insurance trusts. We can get the advanced teams involved or an attorney, or be able to gift those policies to other family members to actually get the death benefit proceeds out of the estate to help give you more liquidity as well. So what's cool about this is you have the policy and you have the asset, so it's an and asset, not an or. Whereas if you had money in a money market or a savings account or checking account, it's either in there or the investment. In this scenario, you get both. Yes, you are paying interest when you are borrowing from the insurance company, but your policy is making that up tax-free, and that's just tumbling 24/7 for you, compounding. Now, the interest you borrow, once again, I'm no CPA, but if you're paying interest to a third party, in this scenario, the mutual insurance company, shouldn't be able to deduct that on your taxes because it's interest expense, right? Business interest expense. So hopefully this was all helpful for you, and we can talk one-on-one. You could reach out, go to lifewithleverage.com, or email me at harper@lifewithleverage.com. I'd love to hear from you, go through any questions you have, help you set up policies or expand your system.